morning. Welcome to IG's Early Morning Call. It's Thursday, the 8th of June. Let's take a look at the headlines as we witness what looks like to be a lower start for the European markets. We've got markets on the way down in the Asia-Pacific session in today's trade, despite the fact we've seen better than expected GDP numbers coming through. The final revision of first quarter figures for Japanese GDP, driven by domestic demand, as we see the Japanese yen gain. But it is, as I said, broadly speaking, going to be a day we're going to be seeing probably some lower starts across the European markets on the session today. And the backdrop to all this is that central banks are continuing to monitor what many are saying is a sticky inflation picture. And there is a revived hawkishness among some of the central banks that have been speaking recently. Take a look at volatility. Despite this, we've seen volatility in the last couple of days drop down to levels not seen since February 2020. So something like around about nearly 40-month lows for volatility. It's picked up in the last couple of days just by a small margin, but that drop that we saw down to Tuesday this week, which was indicating that these markets are more upside rather than downside. That being said, FTSE 100 at the moment at 76.26, now looking as though we could well see some couple of points up on the upside. We have seen some numbers out today from a couple of FTSE 250 companies that might give a steer to the market, but nothing that really is going to direct trade, I don't think necessarily today. In fact, we're now ticking higher as we speak. German DAX on the way down, 15,917, second day in a row of losses there, and the French market's also on the way down. Same sort of price action we got after yesterday's losses, penciling in some more losses at the start of today's session. Overnight in the Asia-Pacific markets, as I said, despite the fact we had better than expected GDP numbers coming out in Japan, the Nikkei 225 are down almost 0.9%. Also, as you can see, there are losses on the Australian markets by a margin of 0.26%. I want to show you what's happening in Japan. This is the Nikkei down for a second day in a row. You can actually see we're well off the lows today. The lows printing something like around about, what was that, 31,419. We're at 31,700 at the moment. So we're off the lows in the session in today's trade. We'll get some more details on Japanese GDP in just a few moments' time. Wall Street's closed yesterday, ending the session up on the Dow, but we saw losses for tech stocks, which took the S&P 500 down in the session yesterday. In fact, if you look at what's been happening in the NASDAQ after that 37% rise from the beginning of the start of the year, a little bit of air taken out of the tires. I don't think this is anything really serious to look at necessarily. It's just a little bit of a breather in what is otherwise a market which continues to trend on the way up. As we've seen in the last few days, companies like Apple, record highs for the stock. So that index doing well. As I said, Wall Street was one of the few markets or few areas where we saw gains yesterday. Third day in a row of gains at the moment, looking potentially for a stronger start at the beginning of today's trade at 33,614. So the Japanese economy. Let's take a look in some more detail about what's been happening. You just witnessed that drop there on the Nikkei 225. The economy grew more than initially thought in the first quarter of this year with that final revision. These show the Japanese economy expanded 0.7% Q-on-Q after a preliminary reading of 0.4% and economists' forecasts of a 0.5% increase, so beating that estimate as well. On an annualized basis, GDP rising 2.7%. From an estimated 1.6%. Now, this upward revision was mainly driven by domestic demand, which contributed 1 percentage point to revised growth. Capital spending rising 1.4%, upgraded from a 0.9%, so that as well showing some positivity. I want to show you the Japanese Nikkei 225. To be frank with you, it's not a massive move. I was talking there about the strength of Japanese yen. It really isn't a big move. This is the dollar down in the session at 139.88. So losses for the dollar against that slightly stronger Japanese yen, but quite frankly, not a lot to write home about. Now, in Australia, the trade surplus narrowed in April to 11.2 billion Aussie dollars. Now, this was below the market forecast of a 14 billion Aussie dollar reading. It was the smallest trade surplus since January, dragged down by a fall in exports. Shipments shrank 5% from the previous month to a 9-month low of 56 billion Aussie dollars. Total exports to China, Australia's largest partner, falling 15.4% from a month earlier. I want to show you what's happening with the Australian dollar against the US dollar. To be honest with you, not a day of massive gains on the foreign exchange markets. You can see here the Aussie up a touch up at the 50-period moving average at 62.8. Now, following the Reserve Bank of Australia's surprise rate rise on Tuesday, Reuters realised a snap poll revealing the economists have also revised their expectations for the Australian economy. A large majority of economists, 20 out of 26 to be precise, now think the RBA will hike its key interest rate once more by the end of September to 4.35%. Now, last week, 25 basis points higher than their previous expectations. Nearly two-thirds, 16 of 26, however, expect the RBA to hold fire at its next meeting on July the 4th. This is all about inflation. And after the RBA on Tuesday, we saw another surprise hike yesterday, this from the Bank of Canada on Wednesday, increasing its overnight rate. I want to show you what's happening with the dollar CAD because this is one of the markets we've been watching this week. And you can see the US dollar dropping against that stronger Canadian dollar, all the way down at 133.62 at the moment, at levels not seen pretty much since the 17th of April. Bank of Canada on Wednesday increasing its overnight rate to 4.75%. Now, that was its highest level since May 2001, sending the Canadian dollar to that 1-month high against the greenback. Since January, the central bank had been on hold to assess what was going on with the previous interest rate rises. It's always interesting to see how long these impacts coming through to the markets when we see an interest rate move. As we pointed out here in the show yesterday, the Bank of Canada had an opportunity to raise interest rates sooner rather than later after that inflation uptick in the month of April. And it's not just the BOC that's witnessing this uptick in inflation and the stickiness that we've got in inflation. The Canadian economy has been relatively resilient so far this year. GDP growth the first 3 months hitting 0.8%. The employment rate's been stuck at 49-year lows the past 5 months. Now, in the statement, the Bank of Canada said that monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation sustainably to the 2% target. And market analysts immediately forecast yet another 25 basis point increase next month. So now, after all this, the next big thing to watch is what's happening with the Federal Reserve. Look at this chart here. This is the dollar basket. It's not much move from the recent highs for the dollar index at 103.61. The Fed is the next major central bank to decide on rates. The two-day meeting will be held on Tuesday and Wednesday next week. But now the Fed funds implied rates show a 33% chance for a 25 basis point hike, up from 22% yesterday. So let's take a look at what we've got in terms of what's happening in amongst some of the central banks with regard to their response to, as I said, this stickiness in inflation. Today, we got the final reading of quarterly GDP out across the Eurozone. At 10 o'clock this morning, first quarter GDP growth rate, final estimates expected flat year-on-year, 1.2%. Meanwhile, US stats later on today, 1:30 p.m. we get the weekly jobless claims, expectations 235,000, and at 3 o'clock this afternoon, wholesale inventory is expected to drop by 0.2% in April, month on month. Now, one of the big things that corporate UK is having to cope with is the prospects of higher interest rates. They widely expected we'll see another 100 basis points at least from the Bank of England. Not when it next meets, but certainly possibly by the end of the year, as inflation just does not seem to be going down here in the UK. Now, this is hitting house builders. Crest Nicholson is warning of a further slowdown in the housing market, with the numbers we've seen out this morning from the house builder posted a slump in first half profit, down to £20.9 million. Now, we saw 52.5 million this time last year. Adjusted operating profit margin halving, 7.8%, nearly halving, down from 15%. Revenue 282.7 million, reflecting the economic uncertainty and lower confidence in the housing market during the first half. That 282.7 million was down from 364 this time last year, 364 million. Crest Nicholson said demand is dampened by higher mortgage rates and broader economic worries. These will continue to pressure on the upside. And I think this could well therefore mean that we could well see some declines for Crest Nicholson when trade gets underway. Full year 2023 adjusted profit before tax expected to be in line with the published consensus. Total dividend for full year 2023 to be in line with the prior year at 17 pence per share. I don't like the look of this report this morning. I think potentially this is a possible short trade on the session today. It's not a trade recommendation. It's just my positioning on this. When I come off this morning, I'll be looking at putting a short on with my stop at around about 255 pence, 249.8. My price target is this drop down here at 239.8, which is the lows we saw just a couple of days ago, back end of last week. So potentially watching for a drop at the start of today's trade from Crest Nicholson. I want to stay on the charts because I want to bring up a chart of Mighty Group. Now, this is one of the UK's largest business services companies, and you can see here we're not too far away from recent highs at 97.9 pence, which were the highs we saw back in June 2020. And I'm fully expecting this stock to beat that line. Revenue, full year revenue, record 4.05 billion. Full year operating profit up to 117 million from 72 million this time last year. Profit before tax more than doubling to 106 million. Really has been on a rip, this stock. As a result of what we've seen this morning, I think potentially there could well be some further upside. 96.1 pence is where this stock will open. I think for my money, it's not necessarily the highs we've seen recently at 97.9. It's the 100 level I'm watching for to be broken. And that would then take us up to levels then not seen since March 2020. So potentially watching for a positive start from Mighty. Wizz Air, another one on the move today with numbers out this morning. This is Wizz Air closing out yesterday's session at 27.87, posting an annual net loss of 535 million euros. But the low-cost airline forecast it would make a net profit in its new financial year. Where this goes, we'll have to see what happens. But at 27.87, I wonder whether perhaps we could well see some more recent lower lows on this stock. Now let's turn on to what's happening with the commodities. I want to begin first of all with oil. US crude oil stockpiles yesterday unexpectedly fell last week. We've seen a lot of uptick in the inventories recently. EIA data showed crude inventories down by 450,000 barrels. Analysts in a Reuters poll had expected a 1 million barrel rise. Gasoline and diesel stocks rose during the period. Gasoline stocks up by 2.75 million barrels. Distillate stockpiles rose by 5 million. Now, this is all due to an increase in refinery utilization rates, up 2.7 percentage points in the week to a staggering 95.8%. Now, that's its highest level since August 2019. Information that you don't get on many broadcasts, but for those that follow oil, this is an interesting element of what's happening with the stockpiles and inventories. This is the turnover between winter fuel and driving season fuel. So it goes with refineries go into generating motor fuel. There's actually not much move in today's session. Second day in a row of gains, if anything, for the price of US crude. At 72.65, I think you can see here trending potentially further on the downside. Staying on the charts again, a couple of other areas of the market I want to follow up on. This is spot gold. Not much move there. Let me just dial in one other chart, which I think is worth looking at, and that is London Robusta, which is the next chart I wanted to talk about. Excuse me, which is the interesting 15-year highs we've seen for London Robusta, 15-year high. Expectations on tight supplies from Brazil. Yesterday, the US Department of Agriculture forecast a 6% increase in coffee production in Brazil, but the details showed that the country is likely to increase its Arabica production by 12%, while yield of Robusta beans is seen down by around about 5%. That's a new 15-year high for London Robusta coffee. Let's take it back at 10:30 with charting the markets, and watch out for Crest Nicholson start today's trade. I suspect that could well be one of the negative stock stories on the session today on concerns about the outlook for house builders.